Okay, so I'll introduce Tammy. I think you have already seen, her credentials. And without further ado, I'd like Tammy to let us know what the main work and responsibilities of a loan officer are, and how the process looks like, and all of the good questions you may have. So I'm just gonna shut up, and Tammy, thanks very much for being here with us today.
Well, thank you very much for letting me join your wonderful group here and say a few words. I really appreciate the time, and I think what you're doing here is fantastic. So many buyers are without guidance, and knowledge is key. And so fantastic things that you're doing here. So I work for LiveOak Bank. We are the largest SBA lender by volume in the country. I believe we closed about just shy of $2.2 billion in SBA roughly. Don't quote me on that, but it's right around that number last year. And we continue to increase that number year over year. It's really what we founded the bank on, SBA lending. So it's what we do. It's not necessarily a department of our financial institution. We are a commercial bank, so we don't have your traditional checking, savings accounts, residential mortgage divisions, that kind of thing. So our main focus is small business, and helping small business owners expand, helping buyers, acquire and find their future, find their next chapter, live their dream. We are very much dedicated to that, not only in our lending perspectives, but in our community involvement and how we approach the small business community as a whole. We are a national lender. I am based here in Florida, but we lend nationwide. And we have loan officers all over the country that are sort of geography specialists. So I am I'm a generalist. I don't have necessarily a specific industry that I focus on. I do all kinds of things. But we do have loan officers that are in specialty verticals, such as veterinary lending or insurance lending or something like that. So we have 27 verticals across the bank that do specialty lending in certain industries. And then we have about 20 general lenders all over the country that are like myself, that do, manufacturing, nurseries, or, anything that you could think of. We don't necessarily just specialize in one industry. And the reason that we do that is because there's a lot of expertise out there in different areas, especially when you're lending in a certain geography. It's important to know the taxes that are associated with that particular transaction. It's important to know the licensing requirements, as we know, or you probably have run into some licensing issues. Well, licensing issues are different in every state. What business licenses are required to operate, the time to get those licenses, and then of course, some of the taxable events that are going to happen depending on which state you are in. So we find all of that information to be very important to our borrowers. We consider our borrowers our partners. You are not only just buying a business, but we as a financial institution are getting into business with you for potentially the next 10 years or 25 years, depending on what you're doing. So it's important for us to be your partner, to help you be successful before and after your transaction, to provide you the right resources, not only with a loan, but resources as far as, how we can help structure with equity, resources after you've purchased your business with, maybe you found that you didn't have enough working capital. How can we help? Do we need to get you a line of credit? Do we need to get you a new sign for your business? What does that look like? What is hindering you from being successful? We always want to make sure that, we have your best interest, as well as obviously the bank has taken a risk as well. But it's important for us to have a vested interest in your success. And I think that's what sort of sets us apart from the rest. We're very much dedicated to the small business community. So I am a general loan specialist. All I do is mergers, acquisitions. partner buyouts. I do purchase of commercial real estate for expansion for existing business owners as well, sort of a rent and replacement. And then we do some leasehold improvements, but it's not our specialty. When we do something like that, we're probably doing it for an existing borrower that's getting into a second location. We do ground up construction loans as well. So there's sort of our specialties and what we do there. We do not do a lot of refinance of existing debt, which is probably not something that you're really looking at right now anyways. As you're trying to get into a business, you're not thinking about refinancing existing debt. So but the main function, the main bulk of our transactions are business acquisitions for business owners or potential business owners like yourselves. I've been doing lending through the SBA program for probably 10 plus years, and in commercial banking for 15 plus years. So I have a broad background of what I can do, what I know about, other types of lending as well. So I can offer guidance on that spectrum as well. We do a lot of things that are different from other lenders because it's what we do. We will do transactions that are over and above the $5 million cap of an SBA loan. They call, there's two different ways to do that. You can do what they call a pari passu, which is a partner loan for an additional 2.5 million. So if you're looking at a large transaction, there's definitely ways to get it funded over and above the SBA dollar cap. You can also partner it with a conventional loan. It would be on different terms because if we're doing a conventional loan, we're probably taking on a little bit more risk. So we're running a shorter repayment on that. So there's definitely different ways to, don't kind of limit yourself. If you've been doing any research on the SBA, don't limit yourself to that dollar because there is a lot of different ways that we can restructure or structure the loan to make it work for you, to maximize your financing of that business as long as the cash flow works. It's sort of an uncommon practice. I don't want to say that just a lot of lending institutions don't do it because it's over and above that guarantee, or it's a little bit more risk. But we're very much a cash flow lender. So if it makes sense and it's a good business and the numbers work, we're definitely going to try to help you accomplish your dream and get that structured properly for you. I know everybody has a lot of questions about SBA, so maybe it might be best just to kind of start asking some questions. So I'm giving you exactly what you're looking for.
I would like to start with a couple of questions.
Sure.
The first one is, let's say I am looking to purchase an HVAC company and I do not hold a license. Mm-hmm. However, I believe that my business management skills are complementary of a license holder. So a good way to go would be, for the purpose of the SBA loan approval, to have the permanency of a license holder in the business as an employee, for which the ideal situation is to offer this person a small percentage of ownership. But that brings additional considerations. One of them being, if this person, it's a minority owner, let's say 5% or some, without bringing cash, but a small portion of equity is given to this person, and of course with the employment agreement in place, providing the different scenarios, termination without cost, and vested interests and all of that. But for the purpose of understanding two situations of the loan, one being the approval, less important, but the other, the possibility of a default. If an individual who, let's say, it's a mid manager, lower level manager, or technician will be in this loan, if it defaults, this person is equally responsible as me. So then a 5% interest may not be fair for this person. Mm-hmm. That is one of the things I find difficult to understand. What would be attractive for a license holder to also be or personally guarantee the loan, which is pretty much what the SBA would like to see. right?
Mhm.
So, and the other, obviously, this person making less money, definitely not being necessary for the purpose of the loan approval. It's more based on first business cash flow, then business assets or collateral, then individuals collateral, and ultimately the SBA guarantee. And please correct me if I'm wrong, but I would like to understand, in particular, the case of a default for a small or minority, owner, PGing a loan, such as a license holder. The second question is about that fund we're looking uh, to have in place to possibly also finance acquisitions and also finance roll-ups, which would be an alternative, to LiveOak, either commercial lending or SBA lending. So from that point of view, we could be competing, but we could also be, complementary. So let's say initially a loan could be from this, debt fund, and later on replaced by an SBA loan. But you said that LiveOak is not as interested on, replacing other loans. So I'm trying to understand if a debt fund loan, right, in 3 or 4 years could be replaced, and what would be, the necessary circumstances for that to be possible.
Yeah. Okay. So let me address that question first because it's top of mind. So I said we don't do a lot of it because we don't get a lot of requests for it. Not to say that it's not eligible or that we wouldn't do it. There are certain guidelines that the SBA requires in order to qualify or be eligible to have a debt refinance, and that is 24 months of payment history to show, and that there's been no default. So what we would do in that situation is, if it's, I think you mentioned 3 or 4 years, so absolutely at that point it would be eligible. It's eligible on the 25th month. So we would just collect a normal application, and then we would collect the payment history from the private group, if that's where it's coming from, and we would absolutely do that if the numbers make sense.
Even though there was no principal payments, because it's a balloon payment on year 4, so just interest.
Yep. So there's two things. So it has to show payment history or have to be on unreasonable terms. A balloon payment qualifies as an unreasonable term. Okay. So interest only payments qualify as payment history as well. So a lot of times when we're thinking about, when we're structuring the loan and we're thinking about a seller note that, the seller is going to need to or want to be paid off prior to the 10 years or whatever the SBA loan is, but it doesn't necessarily factor into the cash flow, we'll assign a small payment, a couple $100, so it doesn't tax the cash flow, but it makes it eligible to be refinanced because it has that small payment, that small payment, but it's payment history.
Right. When you said unreasonable term, meaning the balloon payment is unreasonable, therefore it's a qualifying situation. Perfect. Okay.
Yep, absolutely.
So and then the first question?
Yeah. So the first question is always an interesting question. So anybody that is under 20%, the SBA does not require them to guarantee on the loan. So not necessarily, for a 5% ownership, would that person have to guarantee? No. Could it be requested? Yes, absolutely. But a lot of times on some of the deals that we do where we run into licensing requirements, first of all, we want to know how long would it take that owner to get that licensing. So if it's a year, not a problem. Let us know you've applied for it, you're working towards it, not a problem. Typically the seller will qualify the business for that first 12 months. But after that 12 months, the SBA doesn't want that owner involved. So we really have to kind of know a path forward. We have done several transactions where it is an employee holding the license. And what we've done in those situations, well, I shouldn't say we, but the seller has offered either an increased salary, a bonus structure tied to revenue, if they feel like that salary doesn't necessarily have the desire for them to hold that license, like what's in it for me, right? And so perhaps they pay them a little bit more to hold that license. Maybe they give them a monthly stipend for that license, or some kind of monetary value, because although they may not be putting equity in that for that 5%, and they might not be guaranteeing the loan, they're providing the license, which provides value, right? So that value that they're providing, yeah, again, they may not be on the hook for the loan, but they're definitely providing value. So sort of a trade-off. We usually get an employment agreement, but I don't run into a lot of situations where we can't work through that and make it reasonable for that person, because typically if it's somebody like a manager or something, they've been with the company a while. And so they don't necessarily want to go out looking for another job, but they've got this tangible item that's worth something, and they should get compensated for it.
Okay, no, that works perfect. Then probably your best bet is on looking that there are several individuals with that, capability, in case down the road in 2 years, one of them, grows professionally enough to, leave a company for a greater good. And therefore you have other, potential replacement for the license, right? So,
right.
Okay.
I have also had buyers that have gone sort of a tiered incentive. So to keep that employee engaged, like gifting them equity every year, maybe, they start in at 5, as revenues grow, maybe instead of a bonus, they get another 1% or something to, to make it attractive to that employee to stay, but also knowing that in the back of their mind, they are also working towards getting that license themselves. So if they should find themselves in need of a license in 2 years, they may already have it because they have been proactive. So we want to see them trying to move towards that goal. But some licenses can take, and in Pennsylvania, I think it takes like 4 years to get an HVAC license. I mean, that's just, we would never make a loan to an HVAC license or person in Pennsylvania if we waited for 4 years. I mean, it has to make sense. So.
Perfect. Thank you very much for your answers. Guys, more questions, please, for Tammy.
Like to actually, sorry. Yeah. So I live in Pennsylvania.
Hi.
And as mentioned before, I am speaking with the owner of a HVAC company. What are the implications of that when you say you wouldn't make a loan to anyone that doesn't have 4 years of experience in the industry?
Yeah, so it's for us, it's not necessarily about industry experience. It's about translatable experience, right? Ownership, previous business ownership. What does your resume look like? Do you have management, supervisory capacity? Because in the way we look at it is, you're not going to actually be going out there installing AC units. You're going to be operating, running your business, you managing your balance sheet, the day-to-day, all of that stuff, right? So what is the business acumen that goes along with you that you can translate your experience into running a company, not necessarily an industry, right? The industry is where the licensing piece comes in, and we have to sort of navigate around that. So if you've got translatable experience, from your previous, endeavors, whether it was working, with Target as a supervisor over 50 employees for the last 5 years. Well, okay, what does that look like? You've got management, you've got customer service, you can manage a large group of people. You probably had to manage a department of some kind, loss prevention, all of those things that go into it. So when we ask for a resume, we want you to be, sometimes when people are applying for a job, they kind of, filter it towards the job that they're looking for. And I think that it's important that when you're applying for a loan, also think the same way. What is the translatable experience to this industry that I want to communicate on this? Does that make sense?
It does. Thank you.
Okay.
I would like to piggytail to Jared's question in terms of transferable experience. As Acquire does offer support for not only the identification and acquisition of a business, but the post-acquisition growth and eventually, divestment. Partnering with acquirer would also be, I believe, positive for the purpose of loan approval, wouldn't it?
Yeah. Yes. We often get borrowers that have a board of support that they put together with industry experts. So.
Great. Hey, Tammy, I wanted to ask a question. You mentioned something about being able to get a license potentially within a year. So one of the businesses I'm looking at very closely right now is a plumbing business. And as an engineer, Virginia allows you to get your master plumbing license. Of course, you have to pass the test with 1 year of practical experience and an engineering degree. Is that something that LiveOak takes into account, where I wouldn't have to potentially give 5% equity to another employee?
No, that is absolutely a scenario that we would take into consideration, because you have the means to obtain the license before the seller would, not be able to sponsor that license anymore with your background and the state requirements. So we would match that up. And in that scenario, we would not require you to have a separate person vested in your company with the licensing, because you are capable of doing it within a reasonable time frame.
Excellent.
Tammy, how does LiveOak feel about the e-commerce space?
That is always a very interesting question. So, and that's come up a lot in the last few years, as I'm sure you can imagine, as it becomes a little bit more popular. So we have put certain parameters around e-commerce. I've done a few myself, but we, as banks, we tend to, if we don't understand something, we don't want anything to do with it, right? So I don't understand how a pay-per-click makes money, right? I don't get it. I don't understand it. It's above my pay grade. But so those types of e-commerce, we tend to shy away because we don't really understand how it works. But we see that they're successful, and they have these huge growth spikes, right? So it'd be like a startup, and then the next year it's making $2 million. So clearly there's something to it. So what we have put around for us so that we can kind of get to know the space is right now, if we're looking at an e-commerce business, we want our borrower to have some kind of marketing background, some knowledge of the industry, at least how it works. And then we would like for that business to actually sell a product, and not just be, kind of a pay-per-click or drive your ad to Google, until we understand that type of space. And then we like for it to be in business for at least 5 years at this point.
5 years, okay.
Yeah. And then the other thing that typically comes up a lot with e-commerce is Amazon. So Amazon is fantastic. Jeff Bezos comes to my door every day and brings me a box with a smiley face on it, and I love him. But he creates customer concentration. And so then that becomes, it's a wonderful platform, but that becomes a risk. And so then that's something the bank has to try to navigate through. And so we've put a cap on Amazon concentration right now at 40%. So we like for your sales to be a little bit more diversified outside of, like, typically we wouldn't want any customer concentration more than 20-25%.
Yeah,
but
that's smart. I get it.
I'm sorry. Yeah, but we understand that Amazon, I mean, it is what it is, right? It's Amazon. You're not going to be successful probably in an e-commerce business without utilizing that platform. And it does drive good business. So, so those are kind of the parameters we've put around e-commerce businesses at LiveOak.
Okay, thank you.
Of course.
Tammy, I have a question. It's my understanding that SBA will allow the seller financing up to half of the closing cost. Is that true? And if so, is that across the board or just certain industries?
So I think, are you talking about having it being used as equity, as part of the equity injection, or?
Yeah, part of the down payment.
Yeah. Okay. So yes, the SBA does allow, so the minimum down payment requirement is 10%. Now, we'd like it to all come from the buyer, but that's not always the case that it's going to work out that way. So they do allow for 5% to come from the seller in the form of a seller note that is on full standby for the life of the loan. So they cannot receive any repayment on that equity portion for the 10 years or 25 years or whatever the length of our loan is at all. And it cannot be refinanced. So until our loan is paid off. So yes, that's correct. So it could be 5 and 5. And
can you restate that?
I'm sorry?
Can you restate that?
Yeah, absolutely. So say you're buying a business for $1 million. And so then your equity injection, 10%, we'll say that includes working capital. And so the total project is $1 million. So the equity injection is $100,000. The SBA says that the seller can put in 5%, so 50% or 50,000 from the seller and 50,000 from the buyer. Sometimes that opens up your buyer pool, right? Because they maybe not have less to put down, or they want to have more liquidity on post-close. So it makes sense for us to say, okay, put less down now if the seller's willing to hold note, because then you've got a rainy day fund, right? Instead of using it all at one time. But the caveat is that $50,000 cannot be repaid to that seller until our loan is paid. It's on full standby, no interest payments, no principal and interest. It cannot be refinanced. So that's the caveat to that, is because it's considered equity.
What if in that same scenario, the buyer put down 10%? But they negotiated that the seller would leave 50,000 in an operating account. Even if it was obvious that that 50,000 was not needed in the operating account to operate the business.
Yeah, that's not a problem, because that's cash they're leaving on the balance sheet.
Okay.
So that's not a seller note. So that would not be an issue.
Cool.
And Tammy, just to clarify on that seller note, even if the buyer comes up with 10% and the seller puts in 5%, just to keep the seller kind of on the hook, as you know, they believe in the business, even though the buyer there has the 10% minimum requirement, does that still put the seller not receiving any of the payments or interest until the life of the loan is complete?
Yep. So no, you're absolutely right. So if you're putting in 10% and then you're using 5% to hold the feet to the fire, which we love and we do all the time, then if the cash flow supports, they can get an interest only payment. They can get a P&I payment, as long as the cash flow supports that loan payment. Then it's totally fine for them to get repayment, because it's not considered equity. So sometimes what happens, Ryan, just kind of is that they will want to use 5% as equity, but then they also will need to get an additional seller note to kind of make the numbers work, or that's what they've agreed upon, right? So instead of doing one seller note, I always tell them to break it out, because that 5% is not eligible for any of that. But if you're putting in 5 and then they have a 10% seller note on that other 5%, they can receive payment and it can be refinanced. So you want to make sure that we structure it properly, so that if you want to go ahead and pay them that 5% off, or they want to get payments, that they can do that. So we can separate it into, we can have as many seller notes as we want, right? It doesn't matter, right? But as long as we separate it out so that it works for both parties and it's eligible, should you want to repay it quicker, that you can.
And one last question, I hope for me. What are the things I can do today to speed up the SBA process? Should I want to try to get this thing closed maybe a little faster than typical 3 months?
Yeah. So what I will say is you always want to work with a preferred lender. And it's important because a preferred lender does not go directly to the SBA for approval. So for instance, LiveOak is a preferred lender. So that means we structure our own loans, we underwrite our own loans, we approve our own loans, we close our own loans. The only reason we would need to go to the SBA is if we were trying to collect on a guarantee, or if we had to clear a felony, or there was some sort of affiliate issue that we needed their approval for. Now, some institutions, they do SBA loans, but they have to go to the SBA for approval. And that's where it gets really tedious for a borrower, because not only does the bank have to go through the process of underwriting, approving, then they have to then send it to the SBA, and the SBA always has questions. So then the SBA sends that question back to the bank. The bank goes to you. You go back to the bank with your answer. Then it goes back to the SBA, and it's just a lot of back and forth. So I would suggest no matter who you work with, always ask if they're a preferred lender. That will definitely speed up your process.
That means how short the approval?
Yep. So every institution is different, but I'll tell you just kind of a little bit about our process so you can kind of understand how we try to speed things up for the borrower. So once we get a full package from for a transaction, what we do is we will go ahead and pre-flight that with our credit team, because our underwriters don't make any credit decisions. So to go through the underwriting process to then get to a credit officer that has questions that need to be answered doesn't make a lot of sense to us. So we go directly to credit, we present them with the deal with a brief synopsis, and they say, yeah, we like this deal, go ahead and issue a proposal. If they have questions, they'll let us know, hey, we want the underwriter to dig into these questions so we can give you those questions so you can be getting those answers. And then we will issue a proposal. It's a 6-page proposal. It's going to give you everything you need to know. Life insurance, collateral requirements. It's not just a 1-page term sheet. You like it, you sign it, you send it back. We collect a couple of more things like bank statements from the seller, which we don't typically ask for up front because it's a lot of work for the seller if we're not going anywhere with it. So then we collect a few other things. We send it to underwriting. That's about 7 to 10 business days, depending on the volume. So in that time frame, the underwriter will call the borrower. They'll talk about a few different things, kind of get their business plan, their perspective, anything they have concerns about, that kind of thing. Then the application will go back to the original credit officer that looked at it when I sent it in. So he's already seen it. He already knows he likes it. The underwriter has answered all of his questions for the most part. At that point, it takes him about 2 days to turn it around to get a commitment letter. The commitment letter should be pretty much what the proposal looked like. We send it out, you like it, you sign it, you send it back. Then we assign it to a closer. Within 24 hours to 48 hours, you'll get a closing checklist. And depending on how quickly everybody moves from there is how quickly we can close. What I can do, Daniel, is I can send you a sample closing checklist. So, and it goes through any trend. If it's a stock purchase, this is what you need for a stock purchase. If it's an asset purchase, what you're going to need. But if it's any purchase at all, these are your general items you're going to need. And so that really helps people kind of understand the process and what's involved, insurances and all that kind of stuff.
And the timeline, because from what you say, it looks like 2 weeks, maybe 3 weeks, but tops 3 weeks or, no more than 4.
It could be 30 days if everybody sends everything in. We need 5 days prior to closing to do all of our reviews, make sure the attorneys are on board and all of that. So, you get updates all the time. So you always know where you are. And you're always adding a team member as things go on. Of course, if you decide to do business with LiveOak, you'd start with me. And then we would add your team member with the underwriter introduction. But then, so now you have me and your underwriter. Then we add your closer to the team. Now you have 3 of us. So you're never getting lost in the shuffle.
Yep. And eventually also they need to identify, for example, the escrow agent, and additional, resources they need to engage. So having clarity, of all of that from the get-go is, definitely a help, big help. Appreciate it.
Can I
Ryan,
just say one thing really quickly that holds up closings 99% of the time is life insurance. So if you are looking to buy a business, assume you are going to need a life insurance policy with a collateral assignment. Get it in place. Now, if you don't need it, cancel it. If you don't need it for as much as you have, we can get another one. We can add to it, and that takes less time. But if you've already got that in place, it will speed your process up like there's nobody's business.
And what's the amount you recommend there?
So it depends on so if you have equity to put down, say 375, then you're looking in the $3.5 million range, right? So kind of base it on what you are looking for and what your max spend might be. Get some quotes for it, and always know this, that you can switch it out after closing for a different policy that maybe is cheaper for you or something like that. And you're not locked into this policy just because this is the one you brought to the table for closing.
So you're pretty much talking 100% of the loan amount.
Well, depending, so collateral will dictate how much the policy is for. But I think a good rule of thumb is if you're going to plan to spend this amount on a business, assume there's probably not going to be any collateral, right? Other than maybe primary residence if you own a home. Then, because, probably 50% of the deals come with real estate. 50% of the time you want that real estate. So.
Yeah, very good. Good question, right? So one question before we jump to a list of questions we have from from y'all for Tammy is, and you mentioned working capital as part of $1 million, right?
Mm-hmm.
So could that include some of the pre-acquisition expenses such as legal expenses, due diligence, things like that, even for example, fees you have paid to your acquisition partner like Acquira, or which ones are excluded or possible to include?
Yeah, certain items can go on the closing statement. Third party stuff, I would have to look at it to see if maybe you could send me a sample and I could let you know on that. But typically when we structure something, it's so you only have to bring 10% of the total project. We're going to include all of the closing costs, the guarantee fee, and some sort of working capital. So we typically don't do anything less than 100,000 in working capital. If you need more and it supports, we're certainly going to do that. We try to tie it to a certain amount of time for operating expenses so that you have enough to operate your business. Sometimes franchise fees get real dicey on whether they qualify or not. So I typically say plan to pay your franchise fee out of pocket. Outside attorney's fees, if you give it to us, we'll put it on the closing statement. We don't necessarily include it in the structure of the loan because we don't know how much your attorney is going to cost you, or what those charges are. But if you give us an invoice prior to close, we're happy to put that stuff on the settlement statement for you. Mm-hmm. Just knowing it's going to come out of your working capital.
Right. And I would say with the direct or directly related expenses are a good rule of thumb.
Yeah. Yeah.
Okay.
And when I do, and again, no matter who you work with, be mindful of potential taxes that you're going to have to pay depending on the state. For instance, in Florida, we have doc stamp taxes and intangible taxes. I don't care who you are, you're paying them. And it's a percentage of your transaction. I always include those in my closing costs. My closing costs will always be more elevated than any other lender because I'm including that. Otherwise, you have to bring it to the table. And I find that other lenders don't typically include that, but sometimes they can be $20,000, and you don't want to surprise $20,000 fee on your closing statement. So I try to include those. Now, other states, I know Georgia has as an intangible tax. They don't have a dock stamp tax. So if you want to know, if you're looking at something, I have a template that tells me what states have those. So if you guys are curious, if you're looking at something and you want to know, just send me an email and I'm happy to look it up for you.
Yeah, I have taken the liberty, by the way, Tammy, to post here in the chat your name, title, contact information. Okay.
Sure.
Okay. I have a question from the list of questions provided to us. So one is about what kind of personal collateral is expected for an SBA loan.
That is an excellent question. So the SBA says any and all available personal collateral. So a lot of people interpret that to be, their savings account. That is not the case. It's related to real estate. So if you own a home, they're going to put a second lien on that property. If you own rental properties, they're going to put a second lien on that. And they will do it up to the amount of the loan, so they are fully collateralized. So if you have a lot of properties, you're buying something for $1 million and you've got $1.2 million in equity in those properties, they're probably going to take them all. But what I will say is if you don't own anything, that is not a deal breaker. So if you don't own a home, a lot of lenders will shy away from things that don't have collateral. So make sure you're asking your lender about that. We are not a collateral driven lender. So, again, we're a cash flow lender, but be mindful that if you own real estate and you're doing an SBA loan, they will require that you put a second lien on that property if it's available. Now, if you own it with somebody else, like a business partner under an LLC, it may not be eligible. So there's certain circumstances where that property is not eligible. The state of Texas, no person will not allow anybody to put liens on your property for their Homestead Act. So if you live in Texas, you don't have to worry about it. But that is the only state where it is excluded. And that is an SBA guideline.
And if you have $500,000 in equity in your house and you don't want them to tap that, and you happen to open a HELOC against that 6 months prior to, then it's not available. So they just have to check it, right?
The SBA does a 6-month look back to verify that equity. And it's not just if you have it, you have to utilize it. So the dollar amount has to be there. So
you just can't have it open and in existence for over 6 months. You have to have tapped into it and taken the money out.
Yeah, because then you could certainly look that equity is available because it's unused. So sort of a fine line.
Yeah, that's good to know.
Yeah.
So from what you said, I'm trying to understand, but please correct me if I'm wrong, that you first look at the business ability to repay the loan from its cash flow. Mm-hmm. Then you also look at business, fixed assets as a source of, collateral. And then personal property.
Personal property will come into play no matter what.
Okay.
Yeah, absolutely. And the gap in that collateral versus the loan amount is where the life insurance comes in.
Okay.
Okay.
So then the SBA guarantee is for what purpose? If any of these collateral items are short,
so
or
the
cannot
SBA,
be collected?
Oh yeah, it would that's their collateral. So they're guaranteeing the loan repayment to us for 75%, but they're going to want their collateral, right?
Going out first, yeah. Okay, good.
Yeah.
Another question: which industries are not favored by LiveOak or by the SBA for business acquisition loan?
Yeah, and if I'm looking away, I'm also looking at the questions that you sent me earlier too.
Yeah, it's coming from there. No, I can do that for you.
Okay. So first of all, I'll address the SBA itself. Anything that's tied to direct sales of marijuana, anything in the adult entertainment industry is ineligible. Anything financial, like they make loans, payday loans or something like that.
Pawn shops.
Yeah, pawn shops are
gambling
gambling
industry.
facilities are ineligible. Those are the main ones. So as far as and just know that's all public record. You can look it up at any time. If you go onto the SBA website, if you want to look at the standard operating procedure, you could probably put yourself to sleep in 30 seconds. But there is a lot of information. It's hard to navigate through, but I can again send you a snippet of ineligible businesses right directly from the SOP. As far as LiveOak goes, we don't do any gas stations or convenience stores. Environmental risk is just too much to get involved in there. We also don't do any golf courses. We not currently doing any liquor stores. We do not do any independent restaurants. Now I'm going to put a caveat on that and say, we base all of our decisions on the merit of the transaction. So while we say we don't do independent restaurants, have we done strong independent restaurants? Yes. Currently, we're doing one that's a good deal, and the manager of the restaurant is buying it. Makes sense to us. So if you have something that makes sense, ask. I will give you a quick yes and a quick no. And I will also say, you know what, we haven't done that. Well, let me check and see if we will. So there's not a lot that we don't limit ourselves. We try to stick with the guidelines that the SBA gives to us and not put a lot of our own stuff in there.
Yeah, for the record, as you know, we also consider a possibility of acquire a partnering, right? And if that is also through the debt fund or any other form of association with us, we look at pretty much same. We like to say also any business that inflicts pain in people. For example, we would not enter into a foreclosure type of business. We just don't like it. So
yeah.
And some of these businesses that Tammy described are perfectly legal. It's just not a preference.
And yeah, again, the government, so they have optics, right? They have to say, hey, we don't want anything to do with this, and not to say that these aren't good businesses. It just, the optics of it are obviously out there too.
Okay. I'm looking at other questions, Tammy, and we have covered most of those. Yeah. Let me see. Yeah, I think we have covered all of the questions for the most part. Guys, one last round of questions from you before, we wrap up and finish the call. Actually, I see that some of you have already dropped.
Yeah. I don't know if Andre is still on the call, Daniel, but I wanted to address the issue he's having about the 401k.
He is.
Okay, that is not an ineligible use for equity. You might want to look into a rollover transaction to utilize that and not have the tax repercussions. And there are several firms that do that, but that is absolutely an eligible use of equity, your retirement plan.
Yep, it's called ROBS, ROBS.
Yes.
Tammy, I have a question. In terms of, I'm sorry, how much liquidity do you need after your down payment?
So, yeah, I mean, that's a great question that people don't think about a lot. We do look at post-close liquidity. And kind of the way that we look at it is if you needed to use some of your money for an emergency event, what would you be left with, right? And so that's different for everybody. We look at your credit, what your personal liabilities are. And so that necessarily, I mean, we'd like to see, you be left with some nest egg, but again, every transaction is on its own merit. So, and we are getting a guarantee. But what we do need to do is notate in the credit memo. So should we ever need to collect on our guarantee, why we thought it was okay to make you a loan and leave you with $5, right? So, you know, that's kind of what what's reasonable, what makes sense. And that will all kind of come out in the conversations that you'll have with either myself or the lender that you choose. And if you ever, anybody have questions, you know, about, you know, some of the items, just to make sure that, you know, it's correct. There's a lot of misinformation out there, and I'm not saying that anybody is not telling the truth or anything like that, but always remember there are the SBA guidelines, and then there is the bank's credit policy. So while that bank may not do a loan that will allow someone to use their 401k, that is not the SBA guideline. So there, you know, it's sort of up for interpretation, because, you know, obviously they're, you know, they want to tell you what their limitations are. So a lot of times it will come out as, oh, that the SBA won't do that. That's not always the case.
And one more, what's your minimum debt service coverage ratio?
Yeah, so we require a debt service coverage of 1.5 after new officer compensation. So after your new salary need.
Okay. Thank you.
That's an excellent question. Nobody ever asked me that. It's important.
Very important. And that's including, obviously, you know, the projected financials, right?
So we lend on current financials. We obviously look at projections, but typically it's based on what current tax years are doing.
Okay. So new salary on how does it look on current year?
Yeah, a lot of times the new salary need is less than what the current owner is taking. But sometimes, you know, somebody hasn't advised them how to properly set up their business to sell. So we run into some snags.
That's why, guys, you want to make sure that you look at, you know, what is your salary as a general manager, and if there are any, you know, shortages from what you need, then look at the rest as dividends, which come at the very end of things after making interest and principal payments. Okay, keep that in mind. Well, guys, we're top of the hour, a little bit past. So I really want to thank you, Tammy, and actually, you know, there were many good comments and good questions, and we're not done. So if you don't mind, I would like to have you back, and, you know, in the upcoming calls, probably you know, down the road in a few weeks or probably a couple months. So let's stay in contact. I believe this conversation has been really helpful, very good, very illustrative for all of us, and we really thank you for your time, and well, your information has been shared, so you can expect to be contacted by some of us. Okay.
Yeah, absolutely. I'm here to help, and I wish you all the best in your future plans.
Thank you, everyone.
Thank you, Tammy.
See you next week.
Bye, guys.
Give us feedback. Okay. Bye-bye.